Brent oil is posting its steepest quarterly collapse since 2020, and the Hormuz reopening just poured gasoline on the freefall. The 71.90 level is a trap, not support. With an ADX above 62, the trend is screaming lower. I've got 2 scalp plays and a swing plan that catch the next leg before the herd reacts. Hormuz is open. That's the only sentence that matters right now. While retail is still debating whether to buy the dip, Brent just notched its worst monthly and quarterly loss since the pandemic crash, and the supply shock that's coming will blindside anyone trying to catch a falling knife. I've already got my orders loaded. In the next few minutes, I'm going to walk you through the exact 71.90 trap, the liquidation zone that could trigger a freefall to levels most traders have erased from their memory, and then I'm giving you 2 scalp setups and 1 swing trade I'm stalking this session. This is not a drill. The numbers are on the screen. Watch the whole breakdown, because the hidden divergence I expose at the 3-minute mark changes the entire risk map. Before I unpack the trades, write this down, 71.90. That is the line in the sand, the level where every weak hand stop-loss sits, and where institutional algos park their liquidity grabs. If Brent takes out 71.90 with conviction, the daily trend flips from strong sell to an outright collapse, and you'll want to be positioned short, not hoping. But here's the trap. The herd is staring at that number and calling it support. They're wrong. It's a liquidity pull. The real structural support doesn't kick in until 71.23, and below that, the next magnetic level is 67, a level we haven't visited in months. So keep 71.90 on your screen. If we get a 4H close below it today, the entire medium-term structure resets. That's your invalidation for any bullish bias. Are you paying attention? Comment 71.90 right now if you've got it marked. I'm tracking how many of you are actually trade-ready session bias. We are fading every rip until proven otherwise. The verdict is sell on rallies across all time frames. The monthly picture is still technically neutral, but that's just a slow-moving laggard. The weekly and daily are both screaming strong sell with an ADX of 62. 62. That doesn't whisper trend exhaustion, it shouts trend acceleration. The 1-hour and 4-hour charts are perfectly synchronized with the daily, and the 5-hour just added another lower high. This is a synchronized bearish cascade. The single number that flips my bias? A daily close above 76.27. That's the R3 resistance, and it sits above the 200-day moving average at 83.19. If Brent reclaims 76.27, I'll acknowledge the bears lost control. But that's a $4 rally from where we stand now. Unlikely when Hormuz is back open and the surplus math is inescapable. So my short is on. Now, the micro insight. The herd is positioned net long around the 73.00 psychological handle, thinking RSI at 29 means it's oversold and due for a bounce. In a supply-driven waterfall, RSI can stay oversold for weeks. The smart money is using those trap longs as exit liquidity. Know who you're trading against, because that's where the fuel comes from. Walk the charts with me from the top down. Weekly. Last week printed a massive bearish engulfing candle that sliced through the 200-week moving average, sitting at 83.19, as if it were wet paper. Price is now $10 full below that line. The MACD on the weekly is accelerating negative. Histogram at minus 6.58, with no hint of a bullish crossover. That's momentum confirmation with institutional weight behind it. Drop to the daily. The death cross is already embedded. The MA50 at 89.13 is sloping down, the MA200 at 83.19 is rolling over, and price is trading below every major moving average we track, MA5 at 74.41, MA10 at 77.07, MA20 at 82.07. That's a textbook bearish alignment that quants call a waterfall setup. Every bounce into the MA5 has been sold aggressively for 2 weeks. So why would this time be different? Here's what most traders miss. The ATR is 3.79. That means the daily range is nearly $4. You don't need a 10-cent stop. You can use a 30, to 40-cent stop and still hit 1:2 risk-reward comfortably. In this kind of volatility, tight stops get eaten by noise. You have to give the trade room to breathe within the structure. Now the 4-hour, we've carved a clean sequence of lower highs, 76.27, then 75.26, then 74.59, and now price is consolidating just under the daily pivot at 73.58. That pivot is today's intraday battleground. The MACD on the 4H is rolling over with a bearish cross pending, and the histogram bars are flipping red. On the 1 hour, Williams %R is buried at -94, stock at 26 pointing down, CCI at -102. All three oscillators confirm momentum is in a full-on breakdown. The only thing that would suggest a temporary bottom is a bullish divergence, and we don't have one. Not on the RSI, not on the MACD. And that is the hidden divergence I promised. Most traders scan for regular divergence. Price makes a lower low, RSI makes a higher low. They'll see that eventually and get long. But what's actually happening is a hidden bearish divergence on the 1 hour. Price made a lower high versus 3 days ago, but the MACD histogram made a higher high. That signals the trend is resuming, not reversing. The bears are reloading in stealth. Support levels, exact, S1 at 72.91, S2 at 71.90, S3 at 71.23. Resistance, 74.59, 75.26, 76.27. The path of least resistance is a grind down to test 72.91, then a liquidity sweep to 71.90. Cross-asset linkage. Keep your eye on the dollar. If DXY takes out 106, it's an accelerant for every commodity on the board. And natural gas, if Natty breaks its own support, that's a deflationary pulse that drags oil with it. The entire commodity complex is flashing risk off. That's the narrative web the algos are reading right now. The 24-hour news cycle delivered a seismic shift. The Strait of Hormuz is reopening. That single sentence rewrites the supply forecast for the next 6 months. For months, geopolitical tension was underpinning a fear bid. Traders were pricing in a persistent bottleneck. Now that bid is evaporating by the hour. Analysts are scrambling to revise year-end models from a small deficit to a 1.2 million barrel per day surplus. This is why we are set for the steepest monthly and quarterly loss since the pandemic crash of 2020. A quarterly decline of over 27%. The supply shock is real, and it's not fully priced in yet. On the demand side, China's PMI numbers are softening, and global inflation remains sticky, keeping central banks hawkish. The yield spread between US 10-year notes and break-even inflation rates is compressing. Real rates are biting, which is historically bearish for all energy commodities. Institutional positioning. ETF flows into USO showed over $300 million in outflows last week. The Commitments of Traders report reveals hedge funds flipping net short on Brent for the first time in 6 months. The smart money is already leaning into the breakdown. Now, the 1 to 2 week directional lean. We are bearish as long as price holds below 75.26. That level is the ceiling. A daily close above 75.26 would force a short covering bounce toward 77. But under it, every rally is a short. I want your conviction. Do you think Brent breaks 70 this week? Comment yes or no. I'm tracking consensus. Your answer tells me whether this community is positioned with the trend or fighting it. Most people skip this section. That's exactly where the money is made. Keep watching. I'm about to lay out 2 scalp plays that exploit intraday traps, and 1 swing trade that rides the weekly trend into the 70 handle. These are concrete plans with exact numbers and on-screen trade cards. I've already set my alerts. Do not act until you understand the invalidation triggers. Strategy 1, the opening scalp. This is a high-probability counter-trend snipe designed for the first hour after the London Open. The pivot at 73.58 is today's magnet. Early in the session, price often retests this level as resistance before continuing lower. Here's the trigger. If price taps 73.60 and prints a bearish engulfing on the 5-minute chart, meaning it pokes above 73.60 but the 5M candle closes below 73.55, you have a valid entry. Short at 73.55. Stop loss. Exactly 73.80, just above the pivot and inside the MA5 at 74.41. That's a 25-tick risk. Take profit 1, 73.00, just above the S1 support at 72.91, giving a 55-tick reward. That's 1 minute and 2.2 seconds risk reward. If momentum extends, take profit 2 at 72.50 is your stretch target, but scale out half at TP1. What instantly voids this scalp? A 5-minute candle close above 73.80. If that happens, the trap has failed, and you stand aside. No hoping, no averaging. The opening SCALP entry, 73.55, 5M bearish engulfing after 73.60 tap, stop loss, 73.80 take profit 1, 73.00 take profit 2, 72.50, optional, risk, reward, 1:2.2 invalidation, 5M candle close. Above 73.80 now, here's where it gets interesting. Most traders only see one setup. The second one exploits their stops, strategy 2, the liquidity grab. This is a counter-noise scalp that hunts the stop losses of breakout traders who think the MA5 break is a reversal signal. The MA5 sits at 74.41. Above it, buy stops are clustered. Retail sees a moving average reclaim and goes long. Institutions know this and engineer a fake-out. We wait for price to spike above 74.50, perhaps to 74.60, then snap back. The trigger: a 5-minute close below 74.40 after that spike. Entry: short at 74.35. Stop loss: 74.80, just above the fake-out wick, risking 45 ticks. Take profit 1, 73.65, targeting the pivot area, a 70-tick reward, 1 minute and 1.5 seconds risk reward. This is a fast scalp for nimble traders. Do not hold through a 1-hour close above 74.60. That invalidates the trap because the breakout might actually be real. With an ADX of 62, the trend will resume after the grab, so take your profit and leave the rest for the swing traders. Entry: 74.35, 5M close below 74.40 after spike above 74.50, stop loss, 74.80 take profit 1, 73.65 risk, reward, 1:1.5 invalidation, 1H close above 74.60. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Your response feeds my next live session and tells me what you're ready to execute. Strategy 3, the session swing. This is the trend alignment trade for those who can hold through intraday noise. Based on the daily and weekly. Strong sell, we want to short a rally into the nearest dynamic resistance, the MA5 at 74.41. The trigger: a 4-hour candle that touches 74.40 and closes below it, confirming rejection. Entry: short at 74.20, giving you a good fill if the market retests that level. Stop loss: 75.30, just above the daily A2 at 75.26, giving the trade $1.10 of room, roughly 1/3 of the ATR, sensible for a swing. Take profit 1, 71.90, the S2, and the liquidity trap we opened with. That's a $2.30 move. Risk reward 1 minute and 2.1 second. Take profit 2, 70.00, the psychological magnet and the next big liquidity cluster. Trailing stop rule: once price reaches 73.00, intraday support, move your stop to break even. That locks in a risk-free trade. The entire swing thesis invalidates with a daily close above 75.30. That would tell me the bears have lost control and the weekly strong sell is at risk. But with Hormuz open and surplus barrels piling up, I doubt we see that. The medium-term path is down, and this swing captures the full macro story entry, 74.20, 4H candle rejection of MA5 at 74.40, Stop loss, 75.30 take profit 1, 71.90 take profit 2, 70.00 risk, reward, 1:2.1R, TP1, 1:3.8R, TP2, trail. Move stop to break even at 73.00 invalidation. Daily close above 75.30. Quick pulse on risk. This is the part that keeps you alive. Never risk more than 1% per scalp and no more than 2% on the swing. With ATR at 3.79, intraday whipsaws can chew through a tight stop, so size down when volatility expands. No positions. Through high-impact news, API inventory data tomorrow, EIA the day after, and any unexpected OPEC headline. Stops are non-negotiable. If the trade invalidates, you step out and wait for the next setup. This is how you survive to trade the next geopolitical shock. Let's sum up the single most critical level for the next session, 71.90. If that level breaks with conviction, the free fall into the 60s begins, and the monthly trend will flip from neutral to strong sell. I'll have an updated blueprint 24 hours from now, breaking down whether we are barreling towards 67 or squeezing back to 76 on a bear trap. Tomorrow's wildcard, API inventory data hits, and it's the first real test of whether the Hormuz reopening is physically showing up in storage numbers. If the draw is smaller than expected, or we get a build, the collapse accelerates. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Tap the end screen. It maps exactly how the risk asset decoupling feeds this oil move. Then loop back to yesterday's gold analysis on real yield reversal. It's all connected, and that's how you stay ahead of the macro curve. Hit the bell so tomorrow's alert lands before the open. Smash the like button and subscribe. Every signal helps the algorithm bring you the levels that matter before the herd even opens its charting platform.